Well, just over 2 weeks out from the next RBA meeting, and they're finally just now aligned. But where the real conjecture is the number of cuts we're likely to see. NAB is still forecasting 5 cuts all the way through to the first quarter of next year, whereas ANZ is expecting just 2. On a $600,000 mortgage, that's a wild difference. When you're looking at the monthly repayments at the end of the cutting cycle, you're talking about a difference of $259 in those mortgage repayments. That's not a one-off, that's every single month. So if you've got a mortgage, don't go banking on the 5 cuts just yet.
When we get these rate cuts from the RBA, is it guaranteed that the banks are going to pass them on to their borrowers?
Look, there's no guarantee. The banks do not have to dance to the beat of the RBA's drum, but I cannot see a world where the big 4 banks in particular aren't passing on at least the first couple of cash rate cuts. However, if the RBA really gets going and starts firing off a number of rate cuts in quick succession, we could see some lenders start to hold part of that back to their variable customers, their variable mortgage customers, that is. But look, time will tell. The banks have been saying that they are really hurting under, net margin interest pressures, but I don't see a world where they're holding back those first couple of cuts. Australians are hanging out for them dearly. What's really important to understand is the timing of this process. So the banks typically, they play a game of chicken sometimes about when they announce what they're passing on, but invariably they take between 10 and 14 days to pass on that cut and make it effective on your home loan rate. So when they go and work out how much interest you're going to get charged that day, they do this daily, they will apply that lower rate from about the 10-day mark. Certainly CBA, NAB, ANZ are 10 days. Westpac typically takes 2 business days longer. In fact, in some cases, my understanding is that you actually have to go and do something and talk to your bank and interact with your bank in order to have those monthly repayments lowered in the case of a rate cut. So it's really important to understand exactly how your bank works. Pick up the phone even before a rate cut, understand the process so that you are ready.
And what is the average variable mortgage rate that borrowers are typically paying now?
Look, it's a good question because we've seen it inch down and down and down. 6.33% is what the average owner-occupier variable rate is right now, according to the RBA. Look, it should have been 7.11%, but Australians have been fantastic about renegotiating their mortgage or switching to a better deal. Interestingly, the new customer owner-occupier variable rate is slightly lower at 6.24%. Look, it's only a fraction lower, that's 9 basis points, but it does tell the story that new customers typically get better deals than existing customers.
What do people, though, need to consider if they're going to go through the process of refinancing? Is it always worth it to be switching banks and getting new loans?
No, it's not always worth it, but it's really important to do the maths and do the maths yourself so that you understand all the different costs involved and know that some of these costs are negotiable. So you typically have a discharge fee from your old bank. You're probably not going to get that one waived. It's about $350. You're going to have some state government fees, registration fees. That's around $300 or thereabouts. And then you're going to have potentially upfront fees from your new bank, and that can come in all sorts of forms, which is legal fees, valuation fees, application fees, settlement fees, you name it. They've got a fee that they can charge you, but they also probably want your business and they're probably willing to negotiate on some of those fees if you have that tough conversation with them. If they know that you're deciding between a couple of different options and that's going to get you over the line, then they might just waive those fees altogether. So it's really something to think about. Some people might not be able to refinance for a couple of reasons. They might not have enough equity in their loan. You need to have at least 20% in your loan when you go to refinance. Otherwise, you're going to get charged lender's mortgage insurance, which can often just negate any savings that you get in the short term from refinancing. You also might find that you don't pass the bank's serviceability tests at higher rates, although some banks have lowered them. And then finally, there's some people out there that are potentially in mortgage prison because they can't get home and contents insurance, or rather home insurance.
And just finally, on fixed rates, last week we saw a pretty low fixed rate offered by Macquarie, for example. Are fixed rates even worth looking at given rates are coming down according to most economists and market forecasts?
Well, certainly if you look at what people are doing, absolutely not. The latest ABS data shows that of new and refinance loans coming through, the proportion that are opting for a fixed rate is just 2.6%. That's That's inched up from the floor ever so slightly, but 2.6%, not many people are taking it out because they're really hoping for a flurry of variable rate cuts, and they really don't want to lock in and then have to, see rates tumble, variable rates tumble where their rate stays the same. But then it really comes down to, how many cash rate cuts you think are going to happen. It's a really tough decision to make when you've got ANZ saying 2 and NAB saying 5. When we were talking about those lowest variable rates, 575 is the lowest ongoing variable rate on our database, and then the lowest 2-year fixed rate is 5.49%. That's kind of 2 rate cuts below. So you could see it might be worth it if ANZ's forecast comes out correct, but it's definitely not going to be if NAB's does. And so you've got to put the crystal ball back in the drawer. Think about what suits your finances. Think about what suits your lifestyle. Think about what suits your personality, because if you're going to fret about, what the RBA may or may not do, what the bank may or may not pass on, maybe a fixed rate could suit your personality. Or you could go for a split loan option where you have part variable, part fixed. It gives you the flexibility of variable. It gives you the rate cuts that hopefully will come through. But then you have a portion set to give you that peace of mind.
Sally Tindall, always great to get your insights. Thank you.
Thanks, Alicia.